Well, hello everyone. Here we are, Friday, in what has been a pretty long and somewhat painful week. One of the things I love about our firm is that we don't shy away from tough conversations or tough weeks or tough months or even tough years, which happen occasionally. So I'm here with Jonathan Ting, and who's our director of research and also the lead portfolio manager of the aggressive growth strategy that we run. And I would say we could talk in a lot of different ways about March. It's been the March Massacre, March Madness. It's been a pretty savage change, and particularly among a certain subset of companies, a couple of which we own in Longview, but not too many. But obviously more owned in strategies that are more positioned aggressively, and that has been the particular subset of stocks that has been brutalized over the last few days. So I thought it would be appropriate for Jonathan and I to just have an informal, impromptu chat about what he thinks, and I certainly have my own opinions, which I will share about what's really happening, how to play it, and what really is driving this video is I had a chat with a client yesterday about one of the companies that we own, and we own it in little size in the Longview strategy and in a larger size in the aggressive growth strategy. And they reported earnings last week. We had an interpretation of the earnings report, which I think Jonathan might be able to get into, and a feeling of how we think this will all end for this company. And obviously, we're still positive on the company. But I walked through the metrics, and their conclusion was that was actually really helpful. I didn't really understand why how that all sort of tied together. So I thought if it was helpful for them, perhaps it would be helpful for you as well. And I literally just got off a phone call with somebody who is watching these, I think a newer watcher for the first time, who said some of it's a little technical and some of it, is a little more basic. And I said, we're trying to put a little bit of both in there because obviously we have people coming from all different perspectives when they come to the videos. So we want to give everybody a little something that they can hold on to from these. And if you do have questions based on anything that happens on these videos, reach out. And that's kind of what we're here to do, is make sure everybody understands at least what we're trying to do and the articulation of our strategies and how we're trying to make them feel and perform over time. So anyway, Jonathan, why don't we just throw to you, kind of a crazy, wacky, brutal week. What do you think's happening? Well, how are you interpreting the change in wind direction?
Definitely. First of all, I think it's interesting to note that while it feels like it's been a very brutal weekend, it has been for many people's portfolios and many sectors of the market. If you step back and take a look at the S&P 500, it's only down 4% from its all-time highs. Mm-hmm. So there's a massive rotation going on in stocks that everybody is holding. Mm-hmm. Meanwhile, the industry is not down at all. So while it feels like it's been brutal and what's happening, when you step back and look, nothing much has happened. So it's very interesting. The main thing driving most of this change is, very simply put, the 10-year yield and bond yields, which is something we've been, this is the thesis that you started the firm on. Mm-hmm. So, it took a while to play out, but it's playing out, and we're seeing how people are starting to feel when it does. In a matter of just 2 weeks, the 10-year yield has gone from like 1.1, and we're now pushing 1.6%, mm-hmm. right? So the way I think of it is there are many different ways you can invest in the market. You can invest in stocks, bonds, commodities, whatever. And the way you decide is by looking at the sort of return you can get from that asset, mm-hmm. right? So when you have one entire asset class that's returning you 0.5% return, which was what the 10-year was returning,
right.
Just a couple months ago, mm-hmm. you are crazy to put money in there, right? You're burning your money. So you say, the only thing I can invest in is stocks. You say, well, stocks are so expensive. But the idea is, well, there's nothing else I can do. Mm-hmm. Now that yields are starting to rise, starting to give equity investors some fear that, wait a minute, there might be an alternative in the market So I don't need to hold on to these stocks where I'm only going to make money if they actually grow for the next 30 years, right? Like companies are trading at 50 times revenue. They have to grow at this clip for 50 years for you to make money. They say, wait, I can make money in 2 years if I buy the bond, right? It's a little safer. So we're going through that balance right now. And if we look historically, this is kind of what happens when rates start to rise and the economy is starting to get in that early cycle of a recovery. You know, so when I look out forward and wonder what might happen, of course, nobody knows, but one of the possibilities is that valuations on stocks come down as rates rise, but hopefully we get some earnings growth with this reopening trade, and as more people come back into the workforce and you know, works itself through, companies make more earnings and it sort of balances out. So when I really look forward, I think we're going to have a choppy year. It's easy to say now, but you know, the future does look bright if you look at it on a longer term, I think.
Okay, so I'm going to use that jumping off point to say you have, I would say, articulated with a high level of conviction measured by the size of the holdings, one particular theme in the aggressive growth strategy. We have the same statement expressed in a whisper rather than a shout in the long view strategy. So why don't you talk about the theme, why we think it's important, why we think it will be a theme that will gather, even though the stocks have traded down along with other stocks, kind of like this SaaS business model type software businesses. You know what I'm driving at. So kind of, why don't you talk about the theme and how we're expressing it?
Of course. So I think this is also a good time to explain. I'll explain what the company does. And I think it's by doing so, it'll be a good reflection on how we go about investing in MAGS too, because the same thought process is applied to all the holdings in MAGS. You know, although the thought may be different, the process is the same. So Zixi is an interesting company. We hold it very heavy in MAGS. It's 10% of the weighting in MAGS right now. So it's a company that we have.
Stop there. I just want to make sure we're not using too much jargon. So Zixi is the symbol, ZIXI. If you're looking at your portfolio and you see a large holding in there with that symbol, that's the company, the business that we're talking about. So go ahead.
The company's name is called Zix Software, headquartered in Texas. And what they do is they provide email cybersecurity, primarily in the Microsoft Office ecosystem. So as businesses start up, they typically use Office 365 for their productivity suite. Along with it comes email. Well, Zixi provides the cybersecurity that goes with that email. So most of their clients, or all of their clients actually, are small to medium businesses in the United States. The primary customer size they go after is 50 employees or less. So we're talking small businesses, a lot in the financial sector, a lot in the public sector. So this is a smaller company, and we like it because over time, they've been able to grow their revenues at a very steady clip. There's nobody else in the market at that small to medium business size that's competing with them. Now, historically, small to medium business has been a segment that nobody likes to go after because it's very difficult, right? Small businesses come and go, and it costs a lot just to hold them. That's why venture capitalists like to invest in large enterprise, right? If you got a large enterprise contract, I'll give you money. If you're going after small to medium business, I don't even want to bother. But we're seeing that trend shift. You know, we're seeing a lot of big VCs start to go after SMB because SMB is the largest market in the world. Yep. In the US, SMB companies make up like 60%. So if you can go after that market with a good product, I mean, it's blue ocean. So Zix Software is the only player in that space. Nobody is willing to come down because to build all those relationships with tens of hundreds of thousands of small, medium businesses, you need to be in front of them. And Zix has those partnerships, with tens of thousands of MSP partners that they work with. So they have a really big moat around what they do. They sell their software.
Let me stop you.
Recurring.
MSP is managed service providers, which are the people that do the sort of internet infrastructure for these small businesses. They're companies that go after that segment, and Zixi partners with them.
Right, Zixi partners with them. So what it does is on a gross margin basis, they may look like they're making a little less gross margin than a high, another software company. But what that does is that increases stickiness with the client and, holds them for a longer time. That's sort of what they do from a business perspective. Why we like them as a stock is because they trade off, their business model is SaaS, recurring revenue. So it's very predictable, very steady.
SaaS means software as a service. I was talking to my wife about this earlier. 20 years ago, we all bought Microsoft Office as a product. We paid $450 for, the different, Outlook, PowerPoint, Word, Excel, and then we tried to get our disks to upgrade our software. Now, as I was telling her, we pay $80 a month to Microsoft, along with 50 million a year.
Yeah.
And we get all the upgrades, when they do patches and upgrades, it's all included. So that's the software as a service business, which a lot of people are not that familiar with the term.
Right. So the good thing about software as a service is that you need it to continue running your business. So when you look at a software as a service business revenues, for example, Zixi, you'll realize that there is no single quarter where their revenue drops. Doesn't matter what part of the cycle they're in, their revenues don't go like this. It goes like this. So they've been growing their revenue steady. They've been retaining their customers really well. So typically in the software business, if you're selling to small, medium businesses, the retention rate, the number of clients that you can hold a year is about 80%. 20% of them move because small to medium businesses, die and
go under.
Yeah, they go under, whatever. So 80% is typically the benchmark. You got 80%, you're a good software company. Last quarter, Zixi reported 103%, I think. So they're on par with the big boys in that sense, right? And not only are they on par with the big boys, they're doing better in my mind because they're a profitable company. They actually make profits, they make cash flow. They're able to fund their business. They don't need to give out, shell out shares to people. And what's even better about this thing is that they're trading at 12 times EBITDA, right? They're trading at 3 times revenue. So when I look at companies with similar retention rates, they may be trading at 12, 15, even 20 times revenue. This company is trading at 3. So this is one of those companies in the portfolio where when we see the price go down, I view it as an opportunity to buy more. It's not the same with every company. For example, Palantir is a company trading at 26 times revenue. As that goes down, I might sell out because of what's going on, right? But with a company like Zixi, where the management is very proven, actually, we talk to management once or twice a quarter. We have a call with the CFO next week, actually, to talk about what's going on. It's a business we really like. It's fundamentally strong. It's in the right space. And
let me just make this point because I think this is important.
Right.
So this is part of the, everyone's vaccinated, businesses are starting to reopen, the economy's starting to, while it's the closing represents somewhat of a forest fire across the country, this represents sort of the sprigs popping through the forest floor and the renewal that will happen as the world starts to kind of adjust to our new post-vaccine reality. There will be a lot of new companies and they will be reshaping their old businesses or starting businesses around more software than even before, right? This has been an opportunity for everybody to advance their businesses to include different things. And we think that this will be a potentially an upside surprise over the course of this whole year. I mean, that's exactly what we think.
Exactly. So as the entire SaaS sector is selling off because a lot of those names are trading at 50, 60 times revenue, we have companies like Zixi in the budget that are trading at 3, who unfortunately get traded with them, right?
Yeah.
But if you look at the markets they serve, it's completely different. Zixi is small to medium business. They're right at that heart of the reopening trade.
Yeah.
So, they're going to take part in that. So as that price goes down, it's really an opportunity for us.
Yeah. Okay. So we'll conclude that part of this discussion here. So I want to say a couple more things and then we'll let everyone move on with their day on Friday. So part of the challenge of our job, which we're grateful to have, is we live almost in a state of continuous regret, because whatever we do, we can look at any point in time and see that there would have been something better to have done. So we're always managing the, wanting to do something that might be early, it might be late, we might not do enough, we might do too much. So there's all, we always say there's an infinite number of ways to be wrong and only one way to be right. You have to own it, it has to go up. You have to sell it, it has to go down. Every other combination's wrong. However, when you look at the long view strategy, in contrast to the aggressive growth strategy, obviously we are tailoring it to a different feel. And that's why when you look at the long view, you look at the holdings that have performed this year, and they're the mirror image of the things that performed last year. Last year, the large cap tech trade pulled us through some difficult months and helped facilitate what ended up being a good year. Well, this year, Apple's down 10%, Amazon's down 10%, or were earlier today. Google, actually Google's up, but the point is those names have kind of receded, but a whole new group of companies, some of which we didn't own a year ago, have pulled through and done heavier parts of the lifting, the Chevrons and the Intels and the GMs and these names that, were not popular to add, and we take our share of grief sometimes when they go in. But this is the reason we do it that way, because we're looking for a consistent feel in the long view strategy and a aggressive feel in the aggressive strategy. And when the same way when you're making, when you step on the brakes in a sports car, your seatbelt catches and you lurch forward. This is very much consistent with how we run them, because it has to work that way. This is truly a can't have it both ways equation. So that's why we don't have everybody's money all in one strategy and not in any of the others. Very often we blend strategies to mix exposures and fields. So anyhow, thank you, Jonathan. Proud of you. I think you're doing a great job. It's not always pleasant, and I do think you'll end up being right. Obviously, I believe that, and I think we will be proven right on this idea, which is yours. And I look forward to coming back and giving you your just due when that time comes. But mostly to the rest of you, it isn't always pleasant. But I was reminded by my daughter that a year ago today, she came home from Georgetown from her sophomore year of Georgetown for spring break for 4 days and didn't leave for 10 months. So that was a year ago today. And, here we are, I would say, a lot has happened in the last year, financially.
Feels like it was yesterday too.
It really does. And it's been such a weird, 12 months, but when you just trace where we were a year ago financially, where we were 50 weeks ago, 2 weeks from now, a year ago to today, unassailably tons of progress has been made. And I think on a forward-looking basis, we're actually in great shape. So I know it's tempting to want to say, oh my gosh, that was so pleasant, let's get out now and take our chips and go home. It isn't in reality a really good idea. There are, I think, going to be some really prosperous times ahead. That's my firm belief, but perhaps more volatile. And I think that's okay. We will adjust. We will get used to it. We will play through. As I said to somebody, we sit on the wall, so you don't have to. And we will continue to sit on the wall and make the very best decisions we can. And that won't change. So anyway, if you have any questions or you want to talk about anything or follow up, please let us know. We are here, and have a great weekend, and we will check in with you soon. All right, thanks. Bye.